I'm Hannah Wallace and welcome to FinextraTV for Sibos. Kindly calling into our virtual studio now is Devaney, Vice President, Strategy for Banking and Financial Markets at CGI. So without further ado, Sean, it's very good to have you on again. Thank you for joining us.
Thanks, Hannah. Pleasure to see you again.
Good to have you on, although virtually this time. So yes, today we're discussing one of the standout topics from this year's Sibos, which is stable coins and CBDCs. But I think a good place to start is highlighting the difference between the two. So could you shed some light for us here?
Yeah, sure, hopefully. It's interesting that the Bank of England have recently finished a consultation on new forms of digital money. And actually, they use both terms in the underlying paper that supports that consultation. And I think that's at least in part to get people talking about the difference between the two things, because they are fundamentally quite different. So I think most people are pretty comfortable now with concept of cryptocurrencies, Bitcoin, Ethereum, all those sort of things. But they're more like a commodity rather than a stable currency, and hence have quite a high level of volatility. But stablecoins, as the name suggests, are more like trying to look at a stable currency, look more like a stable currency that you can have some confidence in, what amount of goods or services you can buy from one day to the next. So they're typically pegged against one or more currencies, such as the US dollar or the euro, or a combination, a basket of currencies, but they're still separate from the currency itself. Central bank digital currencies, or CBDCs, are effectively a digital version of central bank money, which for most people today is represented by cash. So for you and me, our access to central bank currencies is cash, or for banks, it's the reserve funds that they have at the central bank. And the idea of CBDCs is that they would provide central banks with the ability to set monetary policy, but via a new digital mechanism, so not just by the distribution of cash or reserve funds. And obviously, as a digital mechanism, it's much easier to distribute than cash, than physical cash. But all of that will be controlled by the central bank in some way, i.e. they can control how much is in circulation, and all of it would be a liability on the central bank rather than being issued by a commercial entity.
All right, brilliant. Thank you very much for setting the scene there. I've got a good handle of the difference between the two now. So taking that into account then, do you think these new digital currencies will be anonymous, like, say, cash then?
Yeah, so I think it's interesting to look at that. One of the big selling points of cryptocurrencies is often that they're seen as completely anonymous. And so there's a great deal of debate about whether a central bank digital currency should be anonymous or not. Or if there is anonymity built into the process, then to what extent should it be allowed? I think it's interesting. We can have a long debate about the anonymity of cryptocurrencies, but they're probably not for today, because I don't think they are necessarily anonymous. I think it's this kind of challenge, though, around anonymity and how it's going to be tracked and traced, and how you're going to balance anonymity with KYC and money laundering regulations. I think that's the kind of challenge that's going to be key to the widespread acceptance and use of any CBDC or even stablecoin, particularly in a democratic economy. So today, cash is about as anonymous a form of money as you can get, but there are limits on the types of transactions you can undertake whilst remaining anonymous. And so for me, the debate is not so much about whether CBDC itself should be anonymous. I think it should be, and that the anonymity should be built in right from the outset. It's very hard to add that as a layer on top. The underlying thing needs to be anonymous. But I think it's about the mechanisms you put in place around that anonymous currency to make it traceable when it needs to be, to avoid money laundering, etc., as we mentioned. Mm-hmm. And so, for instance, you could build that regulation into the KYC requirements for the wallet providers and the exchanges that are certain to arise as these CBDCs become more widespread, and so enforce traceability that way. So looking at the value of transactions that are processed and having the underlying thing itself being anonymous, but then having the mechanisms by which it's traded not necessarily being, or certainly being capped.
All right, that's really interesting. A good angle to come at it there. So we've covered the what how, and now coming to the who will be responsible then for this regulation, for regulating the new digital currencies then? What about that?
Yeah, so so increasing regulation is always a slightly touchy subject in banking circles, as there's already quite a lot of regulation. But I think key to the success of any new form of digital money will be people having faith in it, faith in its ability to be stable, faith in its ability to exist in 5 years' time, and faith in people's ability to be confident that their holdings in that CBDC are going to be stable. A great example is to look at Tether in the US. So a stable coin in the US, originally pegged to the US dollar, but then not quite pegged to the US dollar, and then not linked to it at all. So over a period of time, that went from an instrument that was effectively had parity with a US dollar to something that looked much more like a cryptocurrency in terms of its usage and its stability. So I think, the regulation needs to work around that to ensure that there is a level of predictability around these digital currencies, whether they're stable coins or CBDC. And typically the regulator only steps in when these things become material, right? So up until now, I think we've seen relatively light touch regulation around this space, but I think that's going to increase. I think the latest figures, or a month or so, the figures were around 115, 120 billion in stable coins had already been issued, right? So it's becoming a more material thing now. And I think, what we're seeing is a number of pretty complicated issues that we need to sort out. We talked about anonymity a second ago, right? So one of the basic challenges is who's going to be responsible for sorting out the issues that exist around these currencies, around these coins. So, and I think that's quite a complicated landscape. So the central banks are going to have a view on monetary policy, fine, but probably not on privacy and anonymity. And in the UK, you have the Information Commissioner's Office, and they will probably have a view on the anonymity part, but probably not on the accessibility part. And then there's the whole sort of run on the banks question. If it turns out that central bank digital currencies make it much easier for depositors to withdraw their money from commercial banks in the event of a problem, who's going to regulate and control that? So I think it's a really key area that we have to get sorted out over the next year or two, working out exactly who's going to be responsible for this, as well as the sort of structure of how these things are going to work.
It is. It's going to be a complex landscape, but you've done a really good job of laying down the steps that we need to take to getting a better handle of it. Sean, thank you very much for sharing your insights. It's been a really interesting one, and looking forward to catching up further down the line and reflecting on some of these predictions, and also some good advice we've done there, I would say. So thank you very much.
Thank you, and looking forward again to Sibos this year.